the background and context of SVB's collapse, and how it affected its customers, employees, and shareholders. Silicon Valley Bank, SVB, was a regional lender that served the tech industry for 40 years. It attracted deposits from startup firms and venture capital funds, and invested some of them into long-term treasury bonds and mortgage bonds. These securities typically delivered small but reliable returns amid low interest rates. However, things changed when the Federal Reserve started to raise interest rates aggressively in 2022 to combat inflation. The value of SVB's securities portfolio plummeted, and the bank faced a liquidity crunch. On March 8, 2023, SVB announced a $1.8 billion loss on the sale of securities and a plan to raise more than $2 billion to shore up its balance sheet. This triggered a panic among investors and depositors, who feared that the bank was insolvent. Shares of SVB fell 60% on March 9, and a bank run ensued. Prominent customers like Founders Fund, a venture capital fund led by Peter Thiel, withdrew all of their deposits. On March 10, SVB failed after a bank run, marking the second largest bank failure in U.S. history and the largest since the 2007 to 2008 financial crisis. The collapse of SVB had devastating consequences for its customers, employees, and shareholders. The FDIC took over the bank and guaranteed deposits up to $250,000 per account type. However, many customers had deposits exceeding that limit and faced losses. Some startups also lost access to their funds and credit lines, disrupting their operations and growth plans. Employees of SVB faced uncertainty and anxiety as they waited for news about their jobs and benefits. Some were laid off or transferred to other banks that acquired parts of SVB's assets. Others faced lawsuits or investigations from regulators or creditors. Shareholders of SVB were wiped out as the stock price plunged to zero. Some shareholders sued the bank's executives and board members for negligence and fraud. The former CEO of SVB, Greg Becker, apologized for the bank's collapse in a Senate hearing on May 15, but also blamed the Fed and social media for contributing to the crisis. The reactions and feedback from the public and the media to the apology, and whether it was sincere, effective, or enough, the apology of Greg Becker, the former CEO of Silicon Valley Bank, came too late for many who lost their money and trust in the bank that collapsed in March 2023. Becker, who resigned shortly after the bank's failure, issued a statement on his personal website, expressing his regret and responsibility for the disaster that shook the financial system.